All right, let's get into it. Good afternoon. Welcome to 25 Minutes with Cap. Each month we discuss recent trends in the specialty insurance space. My name is Adam Sills. I'm thrilled to be joined this month by Kerry Jacobs, Senior Vice President and CFO of Alleghany. Kerry, thanks for joining us.
Thanks for having me, Adam. Happy to be here.
Awesome. So as we go on from here, if you have questions through the session, feel free to enter them into the chat and we'll do our best to answer them. And just a reminder that the content of this webinar is the property of CapSpecialty and is for informational purposes only. You're not permitted to republish, share, or quote from this webinar without the prior written consent of CapSpecialty, which can be obtained by contacting marketing@capspecialty.com. So Kerry, first of all, how'd you get into insurance?
Yeah, so believe it or not, I wasn't born thinking I would go into insurance.
I wasn't either.
Didn't expect to. And I actually, first out of college, I worked in automotive finance for what was then Daimler Chrysler Financial Services over in Europe. So nothing really that much to do with insurance, although the cars we leased and financed were insured. I transitioned into banking in New York City after business school, and at first I thought I would cover industrial companies or maybe specialty finance, like related to my prior job. But at the time, the great financial crisis was brewing, and a lot of the action was around financial institutions. So I ended up working in FIG, and in particular gravitated to insurance, where there was a lot of action. I had the chance to work on a number of different deals around, for example, as AIG was dismantled and pieces were sold, went to Hong Kong to take their life insurance company public, and with that kind of committed to insurance and covered insurance companies within my investment banking career.
Sure.
For another around 5 years, and then from there I found my way eventually to Alleghany back in 2014, where I've been ever since.
And so, and when you joined Alleghany, what was the first thing you were doing there?
Yeah, so I started out as a vice president of finance doing investor relations, and then pretty quickly took on risk as well, and then grew in those responsibilities working with the team here, and became CFO in 2019.
Being involved with risk, how is that role changed, if at all, since you started getting involved with it?
Well, it's changed a lot. I mean, I think when I first became chief risk officer at Alleghany, we were really, I was the first kind of standalone chief risk officer. It had previously been a responsibility of the prior CFOs, kind of alongside everything else they were doing. And we had to build out it was the first time we had ORSA for insurance companies, right? So we had to build out our stress testing capabilities and really develop at the group level, how to think about risk aggregation across our businesses. Whereas before, I think it had been, just much, at least at Alleghany, much more localized within the companies.
Right. So Alleghany was acquired by Berkshire Hathaway, and what is Alleghany now? How does it fit into Berkshire Hathaway?
Yeah, it's a great question. So before we were acquired, as right, we had all these non-insurance businesses as well as the core insurance operations, and that was a portfolio of businesses we'd really acquired and developed over the past 5 to 10 years. And within Berkshire, though, since the deal closed in October, we've transitioned those businesses kind of to the non-insurance other side of Berkshire under Greg Abel's management structure. And now Alleghany is really back focused on its core business of property casualty insurance and reinsurance, with TransRe, RCY, and CapSpecialty being the primary operations.
So within Alleghany, you have these 3 different insurance businesses, and you're kind of looking at all 3 of them. Is there a common approach that you have as you oversee these businesses? How do you decide rules of the road?
Yeah, so I think there are certain commonalities, but the businesses are obviously different. So from a governance and kind of structure perspective, for each of the businesses we have standalone, quarterly board meetings where we get an update on the operations. We hear from management what's going on. We talk about risks. We talk about current issues, financials. We also get, as you write to us, a monthly letter from each of the CEOs talking about what's going on and giving a report on the financials. So those are kind of common overall structures. We also, there are definitely commonalities in the way we think about setting incentives, and all three businesses were trying to grow profitably, focused on underwriting profit. So we avoid, and don't have top line incentives. We focus on bottom line. And that's true across the three businesses, although they're in very different businesses. If you have a large property portfolio, we're expecting a very different kind of combined ratio than, if you're focused purely on casualty, where the economics are more on the investment side.
Is there something, as in that role of looking at all three, what's the biggest challenge?
Yeah, I think, I think there's always stuff going on. It's important to keep an eye on, the big picture and the things that really matter, and not get too wound up in, some, an interesting detail somewhere. And we have to focus on the things that are actually causing, risks to the overall organization, or could permeate further or aggregate across the businesses. So, you might find us asking on a question that might be relevant to CapSpecialty or to RSUI or to TransRe, where if we think there could be something that we need to pay attention to.
Sure.
But of course, the businesses, like each culture is a little different. Each business needs something different at the stage that they're at.
Of course.
So it obviously has to be tailored.
Sure. So, one of the things that's in the news from yesterday and today is this RenRe Validus Re deal. What's it's more consolidation of capacity. What's your thought on the deal?
Yeah, it's very interesting. I think that it seems to make sense for both RenRe and AIG. With AIG, seems to allow them to further simplify their business. It seems very in line with the strategy they've been employing in that regard. From what their release said, it sounds like they'll be able to also free up a decent amount of capital with it. So that makes a lot of sense. And for RenRe, you see there are fewer and fewer standalone reinsurers, and that it's a consolidating industry, right? So it makes sense as they're taking out a competitor, and sounds like they'll be able to capitalize on a lot of synergies and kind of align with what they currently do. Yeah.
Is it going to continue, you think?
Consolidation?
Yeah.
Yeah, I wouldn't be surprised.
Right. Do you think you're going to see as much consolidation or continued consolidation in the insurance business in addition to the reinsurance business, or do you see one different than the other?
Yeah, I think right now you have large insurance companies. A number of there can be consolidation in insurance too, but you already have a lot of large clients of these reinsurers that are much larger than the reinsurers themselves. So I think the era of like the small tier or mid-tier reinsurer is somewhat waning in this environment as their clients have more capital. So I think there's more pressure on kind of the reinsurance space to be bigger and consolidate into bigger balance sheets right now than more generally on the insurance side. Of course, there are many more participants on the insurance side. So
sure. Well,
what do you think from your side?
I think on the carrier side, you could see it too. I think it's I think it's harder and harder for people to differentiate and specialize, and that's definitely something that we focus on. But the people who have a tough time with that, I think it's going to be harder and harder to stay in there. But we'll see. One of the other kind of things that you have hanging over the business right now is kind of this kind of emerging, financial concerns, particularly, you have some of these banks going out of business, just as many banks as went out of business in 2008. Is this a different time than 2008? Or not? And there's going to be more concern.
Yeah, I think there are echoes of 2008, right, in this banking crisis. I think those of us that lived through it, you had a few of the similarities, right? That it's natural to draw comparisons, right? You had liquidity crisis, you had failing banks, relatively high profile banks being seized, fear of contagion. But I do think there are very important differences to what we have now and the situation where the banks failed this year versus 2008. One being that the banking system in its entirety is much better capitalized than in 2008. So there's more buffer, especially with the larger banks. But in general, and then, a lot of the issues in 2008 stemmed from, widespread bad assets, right? In the subprime mortgage crisis, a lot of bad loans were made. Those were then sliced and diced and packaged into complex asset-backed products. And the issues were, across the board, across many different participants. In contrast, this year, with like SVB and First Republic, it was somewhat more concentrated. SVB had a very concentrated client base, significant level of uninsured deposits, coupled with, the management of a balance sheet where, the risk of the reversing interest rate trends weren't really taken into account as much, it looks like from the outside, right? Where you had a duration mismatch. So I do think it's a very different situation. I also think on the flip side of that, one thing that's different this time that is worth taking a hard look at is the speed at which it happened, right? You had an old-fashioned run on the bank that wasn't very old-fashioned in how it played out, because folks were moving their deposits with a click of a button and much more rapidly than it's happened in the past. And I think that's something to take note of and to watch, right? Because if confidence is lost again, for whichever reasons in that system, I think you could also have things playing out with a speed that we're not used to.
Yeah, I mean, and bringing it to insurance and reinsurance, when the banks go out of business, the people first look toward D&O. And I'm sure there will be an effect on the D&O of some of those particular financial institutions, but you haven't really seen it in the D&O market. Pricing is really dropped there. Do you see any type of shift coming in that market? Or is it just going to continue to decline in pricing, at least?
I wish it would cause a shift, but I don't think that's going to change things. I mean, the way it looks right now, unfortunately, it seems like we just still have a lot of capacity available in that market. And the trend seems to be continuing. I mean, maybe we'll see some level of stabilization just because we've kind of passed, the year mark and, but it still continues to deteriorate. And I think you just have there are a lot of new entrants in that space with capacity.
Yeah.
And until something else shifts, it's hard to see it changing dramatically. I mean, you guys see it every day, so.
Sure. Yes, and we haven't seen that that it's going to moderate anytime soon. We're not the only ones. I mean, are there other products out there when you look at this financial climate? Are there other products that people should be thinking about, that people should be concerned about, that are not as, that is not as obvious as the D&O products?
Well, I think that, anything that touches, credit is something to watch. So, you got surety of trade credit, mortgage. I certainly think that, we're going to have cost of funding's been going up rapidly. We had what happened with interest rates and increasing so much this year is causing stress already, coupled with this banking crisis we've had where credit's tightening, what the Fed's been doing. So I think that you also have, commercial real estate has, significant issues. So as these things play out, and if we were to fall into, recession as the economy slows and maybe goes into recession, I think you got to look at all those kind of areas as, potential risks.
Sure.
Also, of course, as a recession were to play out, workers' comp is another area that is often impacted as the recession plays out. People lose their jobs.
Sure. Now, conversely, you've seen a real hardening in the property market, and talk a little bit about what you've seen there over the last 12 months. Obviously, it's happening for a reason, and what do you kind of see as kind of the middle end game of that as you look toward the next 12 months?
Yeah. So in the E&S space where, RSUI is in property, we've actually had, rate increases since, 2017. And you see that building, small at first, right? But
Sure.
really building on itself. And now, in this market, it's remarkable, the opportunities that are there as, significant amount of capacity has pulled out. And, we're finding very attractive opportunities. And I on the flip side to D&O, it doesn't feel like anything's changing anytime soon in property. I mean, you have, a situation in Florida. You've got reinsurers finally, demanding higher rates. In reinsurance also, in property, it's a much more attractive place to be than it was a couple of years ago. So with all those factors, it's, more expensive for primary companies to buy property reinsurance. Of course, there are holes in people's programs. And I think that the trend, at least on the insurance side, is going to continue for the foreseeable future. Of course, it depends on also what happens this year, right? If we have a very mild year in terms of losses, then maybe you see some of that starting to reverse as we move into next year. But I think if you have another big loss, or even decent size, you may find it just continuing.
I mean, look,
Yeah.
you talked about new capital going into the D&O space. Are you surprised that there hasn't been at least more new capital going into the property space?
Well, I mean, you do have, the reinsurers raising capital.
Sure.
You saw
Sure.
Everest coming out.
Sure.
And certainly seem to be moving quicker on the reinsurance side. But I think some of it, in Florida in particular, we do have reforms that have happened in Florida which help the situation. But I think you still have folks holding back in terms of capacity, given the dynamics in that market with, inflation coupled with the fraud and underlying conditions. So, I think there's a lot going on, and folks are sick of having losses year after year in property. And I think you find, the alternative capital participants finally perhaps demanding a bit more return in order to participate again. So I think, well, now we'll see. Now, this could be a very good year for folks if there's not a major loss. So maybe you then see, yeah.
What if there is? What if it's,
yeah.
Is it just pricing goes up, or is there more extreme things that could occur?
Well, I don't know. I mean, if I were, if your pension fund, call it, who participates a little bit in property cat, and you've had, 5 years or so of losses, you're not making a good return in this. You now have other options, right? Interest rates are up. There's other places you can deploy your capital.
Right.
If the small strategy you have towards property cat gets hit again, and you get to make, why would you bother? I feel like there may be some that will maintain an allocation, but I think there also will be some that will say, you know what, not worth it.
Is there? Yeah, I agree. I mean, is there? a lot of times when you hear people talking about property business from the sidelines, people talk about climate change. The storms are are stronger. Does that ever come into, how much does that come into the thinking, or is it just something that comes into the pricing? I mean, is that something, are people at a point yet where they're thinking about climate change as a reason to or not to get into that market?
Yeah, I mean, I think that I've definitely heard, particularly from, European investors, and, and others that, one reason they're, some have pulled back in terms of exposures, their belief that the industry hasn't fully contemplated the effects of climate change on the potential losses.
Right.
I have heard that. I do know that, as an industry, and, we in particular spend a lot of time thinking about weather patterns and how climate and weather is going to impact losses, but it's also not something that, it's something that plays out over such a long time, and there's so many factors. It's very hard to be so specific as to how that's going to affect what's happening in any particular year or with a particular storm.
Sure. No, it's interesting. Well, my last thing here was, so 2 weeks ago we came back from Omaha and the Berkshire annual meeting. As people can see here, I've got my Warren Buffett and Charlie Munger squishmallows from the Jazzwares people. But how's Berkshire, from your perspective, how's Berkshire similar to Alleghany? I'll start there.
Yeah, I think it's interesting. Berkshire is obviously so much larger than Alleghany, but culturally, the businesses are quite similar, I think. So we also historically had a very small holding company operation with diverse businesses across insurance and non-insurance. Alleghany always had, to me, a bit of a family office type of feel. So really oriented towards long-term value creation and generation, and not so focused on, quarter to quarter, which I think is also very similar to Berkshire's approach, trying to preserve value, focus on the things that will cause, preserve the business to preserve value and grow for shareholders over the long run. Both had, very high ethical standards consistent with that type of long-term approach. And, we believe in empowering our subsidiaries to operate their businesses independently. And in a way, that's very, very similar to Berkshire. So I think it enabled us to fit in,
Sure.
Pretty well. On the underwriting side also, they're also very focused on underwriting profitability, maintaining a disciplined balance sheet. We only grow when the market opportunities allow versus, generally as many others do. So
Was there anything that you were surprised by at the meeting?
I guess, in general with the Berkshire meeting, it's so much more than just a shareholder meeting. So I think the scale of that is always somewhat surprising, and that this whole weekend event where people related to Berkshire come together and, shareholders, employees, and kind of celebrating the company. It's massive in scale, and I think, getting to know some of the other businesses a little bit in terms of how big and important they are to the economy it's just interesting. It's such a large organization, and insurance is only one part of it.
Yeah, I mean, the thing I was the most surprised by was that there's a corporate culture that amongst all the companies and meeting the different employees, whether it's from Fruit of the Loom or Clayton Homes, that there's kind of there's a niceness and to people that I thought was pretty neat.
Yeah, everyone's been very welcoming, which is just really nice.
Yes. Kerry, really appreciate the time. That's our 25 minutes. If people have questions along the way, feel free to send me a note. But really appreciate everyone tuning in. Kerry, thanks a lot.
Thanks, Adam.
All right, thank you. Bye.
Bye.